Good morning, everyone, and thank you for joining us. My name is David Katz, Gaming, Lodging, and Leisure Analyst with Jefferies. And the next discussion that we'll be presenting is from Six Flags. And we're pleased to have joining us for the discussion is Sandeep Reddy, who's Executive Vice President and Chief Financial Officer, as well as Stephen Pertell, who's Senior Vice President of Investor Relations and Treasury. And I think a couple of other things as well. Before we begin, I just want to lay out what the timing for the session will be. We will run through some topics together, that probably will go for about 40 minutes or so. And then we will open up the floor for any questions. There obviously is a chat function for any of those participants who'd like to chat in questions. We will do our best and make sure that those get raised and addressed. Before I turn it over to Sandeep, I just want to make one very quick comment, which is that we currently cover about 37 companies in our coverage universe, and Six Flags has been one of the feature names at the current point in time for a couple of reasons. There has been, a transformation or retooling that began before the pandemic, that began in very late 2019. And second, it bears some attributes today as we exit COVID that are outdoor, leisure-focused drive to, that stand out across all of our coverage that we think warrants some important attention and position the company for recovery. So with that, thanks very much for inviting me to moderate, and thank you for participating. Sandeep, what I think might make the most sense is for those who are new to the story, if you could just give us a quick overview of Six Flags, I think that'd be a great place to start.
Thank you, David, and good morning to everybody. I think what really bears understanding about Six Flags is we are the largest regional theme park company in the world. We've been that for a number of years already. And apart from that, I think something that has happened in the last few years is we've acquired a lot of water parks as well, which makes us the largest water park operator as well. So it's a very strong model that we have. We have 26 prime locations. And the beautiful thing about this is it's highly diversified. You look across the map over here, you can see that we're present all over North America, specifically in America. And I think a few parks, two in Mexico and one in Canada. And so this gives us a lot of reach across the 10 largest regional DMAs in the United States. And frankly, I think positions us very strongly in terms of what our abilities are to continue to retain market share. So the beautiful thing about this, again, is what David touched on in the beginning. We actually are square in the space of experiences. And I think experiences are where the consumer dollar has been going as a trend in the last few years in a very significant way. And especially in a post-pandemic world, we see this being craved even more and therefore see us in a very strong position in terms of the industry in which we play in, combined with the attributes I just touched on. So we feel that that's very important. Second, I think from an economic standpoint, notwithstanding some of the recent good news that has been coming out of the stock market, I think from a GDP standpoint, there has been a bit of a downturn with the pandemic. But historically, if you look at our performance when it's during downturns, we've been very resilient. And I think there's a good reason for that. We actually offer a great value product, which appeals to consumers that basically come to us from within the geographical driving area for about 150-mile radius, which keeps us very strong. And I think in terms of value for money, it's one of the best values your money can get for an entire day's experience. And I think that is really one of the biggest important things that we bring as a company as well. And this has been demonstrated over the years by a very strong loyalty of our active pass base. We have a very strong season pass program and a very strong membership program. And the combination of those has continued to be robust. Even in the pandemic, we've actually seen pretty good retention on our membership. So I think that's, in a nutshell, really exciting for me because I'm only 6 months in the company. And I see tremendous potential for the company as we exit the pandemic with all the work that we're doing on the transformation front, which we'll probably touch on later during the conversation.
And that is a good segue into the next question that we'd like to address, which is, the company began a major transformation plan that you discussed on your last, earnings call. Can you give an overview of what that is and where we are within that transformation plan at this point?
No, I think that's a terrific segue, as you said, David. To me, this transformation plan, to the point that you made earlier, already had its seedlings planted towards the end of 2019 because our new Chief Executive Officer, Mike Spanos, at the time, had identified that there were potentially opportunities for us to really inflect the trajectory of the business because we'd actually been seeing a stagnating base business where attendance for a few years had actually on like parks started actually slowing down and revenues as well. And so I think we saw an opportunity to reset the business model even before the pandemic started. So the work had already started getting conceptualized at that point. And I think while the pandemic came in March and potentially slowed down the process of progressing with the transformation work for a few months, I think once we lifted our heads up in the end of April, early May, and said, okay, we've got the financing raised for the company that actually secures our medium term, we just looked back and said, but everything we were talking about on transformation is just as relevant. And we'll just work through the duration of the pandemic to make sure this happens. And so the work has actually been done now, and that's why we came out on the last earnings call in October and talked about the value generation potential from the transformation plan. And our expectation is this transformation plan is going to generate an incremental run rate EBITDA on an incremental basis of $80 to $110 million in value, getting us to an earnings baseline of $530 million to $560 million. And the reason it was from 530 to 560 million is, for those of you who had followed us through the fourth quarter of 2019, when we announced the fourth quarter earnings, which is in February of 2020, we'd actually talked about some headwinds that the business was going to be facing. And compared to last year's reported adjusted EBITDA of $527 million, we expected that the going forward EBITDA was going to be materially lower, and the midpoint of the range of expectations we had was $450 million, and that was 435 to 465, if memory serves me right. And that's the bridge, basically, to get from 450 from 450 to 530 to 560. So where is this value coming from on the transformation plan? $50 to $70 million. If you go back one, Steve, to the previous chart, I think that'll probably help to just peg on that. So $50 to $70 million of savings are expected to come from the cost side, with 40 to 55 million coming through fixed cost reductions, which are independent of attendance. And in addition to that, there's another $15 million, which is from variable labor, which is linked to attendance. The other $30 to $40 million is expected to be achieved through guest experience marketing and in-park initiatives, which are super exciting. We see a lot of potential over there, and we'll talk a little bit about that on the next slide. But I think there's more work to be done to actually see that value being generated, especially attendance coming back. So let's go to the following slide. And I think over here, I'm going to start on the right-hand side of the page because I talked about that first earlier. And let's talk about the cost efficiencies, and especially the $40 to $55 million of fixed cost, which are really more directly in our control. And we expect to realize that by 22, with a significant portion of that already being realized in 2021. We actually talked about $30 to $35 million of value that we should be able to generate in 2021 as well. The first of those items is the organization redesign. And I think what we noticed when we came into the company, both Mike and then later myself, was we'd actually had an opportunity to consolidate a lot of activities from the parks into a functional shared services center and provide services to the parks. And through the process, also reduce layers and make sure that we invested in technology to enable new employee capabilities or enhanced employee capabilities. And I think there's significant value unlock that's expected to come from this. The second, I would say, is what I touched upon earlier, which is from a seasonal labor standpoint, we are heavy employers in the markets in which we operate of seasonal labor during our peak periods, especially. But we have the benefit of technology over here too, which is we have artificial intelligence tools that can actually enable us to learn from trends and therefore staff more effectively to match the staffing with the actual demand curve in terms of when the attendance comes into the parks. And this staffing optimization model is expected to yield a lot of labor optimization and labor optimization dollars that should generate value for us. And that's just the defensive part of it. Frankly, if you actually put labor in the right place at the right time, especially during peak demand periods, you have an opportunity to use it as an offensive or revenue generating element as well. The transformation plan we're talking about doesn't include the revenue piece. It just talks about the cost piece. And then last but not least, Six Flags is a large company where we have multiple properties, like I just mentioned in the initial comments, but we haven't really fully leveraged the scale of Six Flags to this point to consolidate vendors, to renegotiate contracts, and to drive incremental value that can be reinvested in the business or taken to the bottom line, depending on what views we see for the resources. So big piece of value coming on the cost efficiencies, a significant portion of it, $40 to $55 million, which is not dependent on attendance and completely within our control that we keep a drive on. The other piece of it, which is more on the left-hand side of the page, is really about modernizing the guest experience by leveraging technology to doing it. And I'm going to talk about that more, I'm sure, in other questions that come up during the conversation. But there's a number of pieces over here. And I talked about park level labor and using AI over there. Same thing with media ROI. We can use AI and data analytics to actually look at returns on our media spends by park and by channel. And we're using that to actually redeploy and reset media budgets and flex them by park and by channel to get better ROI on the money that we spend. And we think it's so strategically important to the brand that not only are we so convinced that we're going to get better efficacy, but we're so convinced that we'd like to increase our spend from the historical 3 to 4% of sales to up to 4 to 5% of sales, and actually use it as an offensive mechanism to actually drive more revenues and drive more share. Second over here is redesigning the website and the search engine optimization. We did some work on this already in the 2020 fiscal year, where we completely redesigned our website, and we have tested it. We did A/B testing of the website. We saw significant improvement in conversion. We saw double-digit improvements in conversion, and we launched the new website in all our operating parks in October. So we're live, and we're seeing good results already from what we've seen through October. And then pricing and promo is a place where we were doing work, to your point, David, even earlier in the year, in the first quarter, where we saw significant improvements in attendance and in single-day ticket sales in the first quarter by optimizing our pricing and just making sure that we're moving along the elasticity curve to drive incremental demand and incremental revenue. And that has actually already shown good benefits. You saw our single-day ticket sales going up in the third quarter, which is very exciting in the face of what we're doing. And I think Mike said it before, but I will say it as well. Single day tickets are an and, not an or. We want to maintain our active pass base and growth, and we want to grow single day tickets on top to actually drive incremental attendance and incremental revenue in our business. And then last but not least, I'd say optimizing culinary and retail offerings. Almost $1 in $3 that is spent in our parks comes from here. So there are significant opportunities in terms of the scale of spend that happens over here to optimize and actually maximize the value that is being spent by the consumer or the guest that's coming in by adjusting the pricing, assortment, merchandising, and just making sure they're getting a better value and better experience, which goes back to modernizing the guest experience in the first place. And this is another area that I think there's a lot of value that's there to be unlocked. So on the left-hand side of the page is $30 to $40 million of value. Frankly, like we said before, this is just the baseline. This is the earnings baseline that we want to get to. We're not going to stop at the earnings baseline. This is about reigniting growth in the business, top line and bottom line. And this is about setting the platform to get to that top and bottom line growth. And we'll talk to you more about that as the year goes on.
I just want to follow that up, and I appreciate all of that detail. I recall, I believe it was the last week I was in our office, we hosted a video conference with Mike Spanos, and he made the comment that the company had a state-of-the-art CRM system that presented opportunities to use better. What learnings have you captured so far about the customer base through use of that CRM system that would be noteworthy and present opportunities?
That's a great question, David, and it's actually interesting because and this is a pure coincidence because we didn't talk about this. Mike and I were chatting last week about us doing this conference today, and he remembers that conversation very clearly. And his interpretation of that conversation is slightly different. So let me just start with that, and then I'm going to get into that because what you're talking about is very relevant. Which is what I think he was trying to explain was we have a treasure trove of data about our guests and consumers. A treasure trove. We are very rich in data. What we have not really had is the ability to unleash the potential of that data. And that's where a state-of-the-art CRM system comes in. And that is exactly what we're investing in right now. And that's why we talked about technology to modernize the guest experience. By investing in a state-of-the-art CRM system, we'll be able to personalize that guest experience. We'll be able to actually give them exactly what they want as soon as they want it or in a reasonable time frame to when they want it. And so we're thrilled about the potential that this actually opens up for us. We're already well down the path of actually doing this. And so we expect to have this completely implemented in 2021. And I think it's one of those things where you're never done with technology, right? You put something in, but you keep on having to enhance. It's continuous improvement on that. But to me, that if I look at the technology investments and the guest experience, this is the thing which I'm most excited about. It is the single most important thing that we're investing in, I think, from a guest experience standpoint in the coming year.
So, look, I think you've provided an awful lot of detail around the operating model and the transformational plans. What I think has been more of a stay tuned is around capital allocation. And historically, the company has invested in new rides, new coasters periodically, et cetera. What can you share with us about what we know so far about that capital allocation plans and the work that you've done since joining?
I think the capital allocation of the company is something I'll get into in a couple of minutes. But what I will say is the company has invested about 9 to 10% of its revenues. Sorry, just want to make sure. Can you still hear me?
Yes.
Yeah. So the company has historically invested 9 to 10% of its revenues in capital over the years, and frankly, it's worked very well. I believe that it makes a lot of sense, and we've talked about the fact that it's unlikely to change significantly. What I would say is interesting as we've gone down the path of actually examining the guest experience is we see a potential to basically redeploy some of that spend towards the guest experience. And we touched on a few of these things, right? If a third of the spend is going on in-park experiences, are we spending the right amount of money on supporting those in-park guest experiences? And I think that's something that we'll probably think about addressing. The second I would say would be from a technology standpoint, we don't think it's a significant adjustment, but it should be more of a focused adjustment on what we're spending on capital on technology. And then I think the last piece, which I think is the most material value that we spend, is on rides and marketable capital. We don't think that there's going to be a significant change in this spend either the marketable capital or the asset maintenance spend that goes along with that marketable capital, but really a refocusing to make sure that we're deploying the capital to basically parks and markets where we see more significant growth potential. So that's kind of the evolution, I would say, of where we believe things are going, and I'm actually pretty comfortable that as we move along during the course of the year, probably by the time we get to our fourth quarter earnings call, we'll be in a position to provide a bit more clarity and detail on this.
Right. And so what obviously dovetails off of that issue is, how you focus on leverage, right? Coming out of the pandemic, I think most companies are in a position where they have to sort of reset and find their way back to a normalized leverage level. How are you thinking about what that level is and what the path is to getting there, while balancing those capital investments that are appropriate?
Yeah, and I think we've said previously, and I'll continue to reiterate that we're looking for leverage to be at 3 to 4 times EBITDA, and I think obviously when we came out of 2019, we already were at the edge of it at about 4 times EBITDA, and so we need to make sure that we bring those leverage ratios back in line with where we'd like them to be. What I would say is in the initial short to medium term, we feel pretty comfortable that we have the liquidity to ride through the pandemic. Obviously, since the last time we had the earnings call, there's been updates on the vaccine, which is very positive. I think the question is now distribution of the vaccine, when the population gets to more herd immunity, when some of the restrictive measures that are being taken right now start to ease. So those are all short to medium term considerations that we'll navigate through. So I think in the short to medium term, our debt levels will remain elevated, but we believe we have the liquidity to ride it through. And we also believe that once attendance starts to normalize, it's more a question of actually bringing those leverage levels back into where they need to be. We believe we can do all of this by investing in our business and making sure that we continue to invest in our assets to ensure that when attendance starts normalizing, when guests come to the parks in full force again, we basically do not have a business that's been starved of investment. We will make sure that the business is invested in to sustain that long term.
If you don't mind, I'd like to just follow that up, pardon me, because it comes up with investors around covenants and your current leverage profile. It might be appropriate to just take a moment and talk through where those are and what the timing of those are as you have it.
Yeah, and I think that's a very, very good question and very fair, David. So I think the good news on the covenants is we basically got an extension. We got an amendment back in August of this year, or last year, sorry. Keep forgetting we're in January. So we got an extension of where essentially there is no testing to be done in 2021. And I think we're going to have and modified testing to be done in 2022, where we take the rolling 4 quarters. So as of now, I believe that this puts us in a much better position from a covenant standpoint, because to the point I raised earlier, with the vaccine news, with the expectation that things will start easing as we go through this year, we should be in a much better place from both a liquidity standpoint and a covenant standpoint, where we're not going to be really under that much of pressure relative to what it would have been if there had been no vaccine and there had been no expectation of distribution. So my answer is a bit different because of the environment that's changed since our last earnings call.
I'd like to talk about just the distribution of parks. You made the comment earlier about your diversification geographically. If you can talk about parks today and which ones are EBITDA or free cash flow positive, and how you expect that portfolio to evolve as we move through 21, as best as you can tell for the moment.
Yeah, I think we've said this before in a couple of calls. We aren't operating a park today if it's not at least from a variable cash flow standpoint, EBITDA positive or cash flow positive. So that's a starting point. So except for 9 parks, all other parks were operating. So by definition, they were cash flow positive on a variable basis. But I think what we've talked about is we're highly diversified. So different economic characteristics based on each park. But overall, I think if we think about it, we laid out some break-even points for where we think the company needs to be at an attendance level. And so we talked about break-even EBITDA really coming in at ranges of attendance of 45 to 55% in aggregate across the portfolio. And it really depends on the park mix. So that's really what's driving that range. So a good park, if a very strong park basically contributes to that, it could be at the low end of the range, and vice versa if the opposite happens. And I think the same thing I would say about free cash flow break even. 65 to 75% attendance is kind of the range that we see on that one. So I think that's how we're thinking about it. Honestly speaking, I think with what we're looking at, none of our parks are in poor shape in that regard. And I expect, if anything, the outlook for 21 is a lot better than the outlook for 20 was, with things being pretty murky. So I think we go to greater strength as opposed to less.
What I would love to talk about is, and this is such a common theme across all of the leisure coverage for us, is the notion of pent-up demand. Are you able to measure or provide any data points or any anecdotes that support the notion that there is a pent-up demand that just needs the parks to open, right, and the regulatory barriers to remove, and that demand will show up?
Yeah, no, I think what's really indicative of this pent-up demand is, frankly, our membership. We started the year with 2.6 million members. And I think regardless of the situation, we've been doing a lot to make sure that we're showing our members our loyalty. We've offered them the option to, we've given them month-for-month extensions if they weren't able to use the park. They continue to use the parks, continue to pay. They actually got extended benefits on their membership tiers. And really speaking, they've rewarded us with their loyalty, because even though they have the option to pause, notwithstanding, very few have paused. I mean, only 14% have paused at this point. And if I look at where we started, I think we had 2.6 million members at the beginning of the year. I think we're down to 1.9 at this point through the end of the third quarter. So 1.9 million versus 2.6, you would think is actually a decline, but in the circumstances, it's a very small decline, I would say, showing the stickiness and loyalty of our membership base. And even the season pass, look, between Q2 and Q3, we saw an increase of 200,000 in season pass sales. Why would people be buying season passes in the face of the pandemic? It's because it's such a wonderful experience for them that they're coming out. We weren't even advertising it. They just came out and bought it. So we thought it was the right thing to do for those that already bought 2020 season passes to actually extend them into 2021. But just as a reminder, only 20% of our season passes basically remain, and the rest of them churn every year. So that's not going to make a huge difference from a cash flow standpoint to us, but it makes a huge statement to those season pass holders that we acknowledge and recognize their loyalty, and they want to keep them in the program for the extra year. So overall, I'd say there's a lot of stickiness that I see from the way the consumers and guests have been behaving with the brand. And I feel that we should see a significant ramp back of that consumer demand from the active pass base as we move into 2021.
With respect to your visitation, one of the most important topics has been the single day visitor versus the multi-visitors that you just described. Have you observed, is there anything observable with respect to single day visitors within your database that suggest, a demand to return?
Yeah, no, I think what we've been really pleased about is we saw this in the first quarter, but it was pre-pandemic, where single day ticket holders basically came to the parks and actually drove a lot of the growth. But what's been really interesting is as we moved through the second and third quarter, mostly the third quarter as well, we saw the continuation of that strong single day demand come through. I just talked about the active pass base. They've remained pretty strong in relative terms, even though the pandemic has been ongoing. But the single day ticket holders have definitely showed a strong commitment to return, because we're connecting with them and bringing them in as well. And some of them actually end up spending a lot more per visit because they come for the single day visit. So that drives up our in-park spend as well. So the per caps that you saw in the third quarter were driven a lot by those single day ticket holders. So it's definitely very accretive. And I think it probably was masked a little bit because so much of our in-park spend was coming from so much of our revenues or attendance was coming from Safari, our New Jersey park, where there's very limited opportunity for in-park spend. If it weren't for that, our in-park spend would be up even more. And so I think it's a very positive sign that we have more single day tickets coming in. But again, it's an and, not an or. So we should be incremental in terms of revenue.
Just following that up, I know Mike has talked about, and you all have talked about, the notion that the single day visitors, had been somewhat overlooked in the past, or had not been fully engaged and activated in the past. How do you see the mix within your visitation, corporate wide, or even, regionally? So how do you see that mix evolving as we move into what I hope and expect will be a more normalized 2022?
Well, I think it's not so, but it comes back to the and versus the or, right? So what that means is essentially which one grows faster, not about what the mix is so much, because we want to grow both. And so to the extent that single day tickets perhaps were not as leveraged in the last few years, you could potentially see out the gate faster growth from single day tickets. But I think over time, we would expect, if you're addressing all the different cohorts equally, you should see growth everywhere. And so that's really the way we would think about it from a short-term versus a medium-term perspective.
You have within your portfolio some non-wholly owned parks. You have some leases that are ending. Any thoughts on how the structure of those might change, buying back some of those, ownerships? And obviously, one of the prevalent questions that comes up around Six Flags frequently is around any OpCo, PropCo potential strategies, which are prevalent across leisure today?
Yeah, I think we took a look at this a couple of years ago, but we didn't think it made a whole lot of sense to make any changes at that point based on the economic characteristics of that change. And honestly, David, I think when we look at our business, we see so much value in optimizing that base business that we're just trying to focus on driving that value from that. And that's what the whole transformation plan is about. So once we get done with that heavy lifting and we're through with that, it should take not too many years, but once we get done with that, you then have an opportunity to think about some of these other things that we're talking about. But for right now, it's really focused on the base business and drive the value from there.
Understood. And with respect to international growth, and I think much of this predated your arrival and predated Mike's as well. Any thoughts about whether you have the right assets, tools, expertise to drive and reinvigorate an international growth pipeline going forward?
Yeah, I think number one, the Saudi business, the Saudi parks are basically on track. I mean, the Qiddiya partnership continues to be an important one to us. So to do that, we essentially have a setup to actually support that international park expansion opportunity, which is great because we'll have that in our arsenal, if you will, if we want to actually double down and go after that in the longer term. But in the short term, it's back to the answer to your previous question. We want to focus on our base domestic business and drive value on the base domestic business. But we're keeping the optionality because we have the partnership in Qiddiya, and we can at the right time actually look at that as a potential expansion opportunity. But it would require resources, both human and to some extent financial capital. And so we just want to be choiceful about where we deploy the resources in the short to medium term, and then that could pivot in the longer term.
All right. With that, I'll just step in for a moment and pause and remind people that if there are any specific questions on Six Flags or for the management team, those can be chatted in, and we will certainly make our effort to address those as best we can. In the interim, I'll go back and follow up with some of my own questions if that's okay with you all. Look, I think among the most prevalent questions and issues we debate with investors in a normal course is what the health and interest of these consumers will be post-pandemic. Mike has talked about competition from internal, from travel sports, from video games, from sort of other activities. How do you think about matching up against those and competing with those things? And then secondarily, when we look at kind of the consumer economy, there certainly is lively debate about job losses and the impact of COVID and how much of that lingers, coupled with what we've seen from both many market analysts, ours internally as well as broadly, that we could come out of this with a stronger economy at the end of the day. So I would just love you to walk across the different demand drivers economically, both within your consumers and more broadly, and set the context for Six Flags and what a 2022 normalized year could be. As I know there's a lot to unpack there, but I think these are important issues that come up regularly with investors for Six Flags.
That's a great set of questions, David, because one is more long term and the other one is a little bit more short term, right? And I think if you look at our consumers or guests and potential players in the market, what we have is a unique set of assets today with the parks that we own and operate. And within North America especially, if you think about the catchment area in a 150-mile radius from where our parks operate, there are probably close to 200 million people who could potentially be guests at our park. So the key over there is to ensure that from a guest experience standpoint, we delight guests completely with what experience they're getting. So not only do they want to come back themselves, but they also bring their friends, their family, and bring larger groups of people into the parks to drive greater attendance by making sure that that experience is wonderful. So I think that's fundamentally, we're already positioned in a place where we have that ability to bring in a lot of guests without doing much more than just performing our basic task as a regional theme park more effectively. And that's what goes back to modernizing the guest experience and delighting the guest with everything that we offer through the transformation plan. And so by doing that, you're going into the space of all location-based entertainment in that DNA, effectively. But why do customers or guests come to us in the first place? It's for the thrill rides and the food experiences. So we want to make sure that we're focusing on what we do best, which is offer them those thrill rides and food experiences. And that's why transformation is focused on elevating those experiences for those guests. And so we'd rather basically focus our investments and capital on doing what we do better and bringing more people into those kinds of experiences because we become the best in the business at doing that. Okay, so that's the first part of the consumer demographic and what we think we can do. Then I'd say the second part of it is really about what happens in the economy, what happens if we actually bounce back with a much stronger economy and stronger demand. I think all that happens is the transformation value accelerates. You just get it much more quickly, and then you pivot to growth even faster. That's all that happens. Because to me, I said earlier that we are pretty resilient even in a downturn economy. So even if it doesn't happen, even if the economy goes into a bit of a slump and GDP and personal disposable income slows down, I think there'll be a good amount of business that we will still generate because we are the value operator in terms of entertainment options for those guests who will continue to actually come to us until the economy bounces back, and then we'll see the growth.
I do think that dovetails into a question that's been chatted in about virtual theme parks and virtual activities. Have you explored or thought about pursuing those kinds of things corporately rather than just combating them head on?
Yeah, I think there's a distinction between virtual reality, virtual environments, and location-based entertainment, which is based on being in the location and actually experiencing it on the location. And I think because we are a theme park, which is a destination for people to come out and spend a day in the outdoors and actually ride all these wonderful rides and have the physical thrill of going through that, with assets that are very hard to replicate, we stand in a very good place, I think, as opposed to a weak place because of those barriers to entry. So it's interesting to think about the whole virtual world, but then you're breaking down the barriers to entry effectively by competing in that space. So it doesn't necessarily, while I understand the appeal and there's demand out there, are we the right people or the right company to harness that demand? And I think we stand a better chance of harnessing the demand in the models that we have with an enhanced operation than trying to go and do that.
And just to follow that up, I think one of the endeavors that we have seen in this current environment is, using virtual activities as a vehicle for extending the relationship with consumers in lieu of, they're visiting the park, or as, an advent of getting them to come, visit the park, to engage with them in some virtual format, build some, engagement, some loyalty, and induce them to come in? Is there not an extension strategy, if you will, that could be available to Six Flags, as a follow-up to that question?
Yeah, and I think that's a very good follow through, because to me, that's fine because it pivots off the core experience in the park, and it's basically a filler between experiences in the park, which maintains that connectivity. That's something that we could certainly consider. I haven't actually talked about this extensively inside the company, but certainly that's not off the table. To me, that's part of the guest experience. And I think Mike talked about this on the last earnings call. For us, the guest experience starts well before the guest enters the park and extends to well after the guest has visited the park. So that is exactly where this kind of experience would fall in. And it makes a ton of sense for us to think about it, as long as it's of value to the guest and delights them.
Now, I think one of the first activities Mike engaged in, which I guess was a year ago, was visiting all the parks. If we were to have accompanied him on all those trips, how would we have viewed the physical condition of the parks? Would we have seen some that are a bit tired, or would we? What would our assessment have been?
I think it probably depends a little bit on which park, David, because I was based in California, so Magic Mountain was the park that was closest to me. So even though it was closed, I've actually gone out and spent quite a bit of time in Magic Mountain. The park's in pretty good condition. So I think that would be the answer I would give you for Magic Mountain. But then if you go to other parks, maybe it wasn't as consistent. So there is a bit of work that needs to be done to get the business or get the parks back to conditions which are optimal. Mike talked about it on the February earnings call, that we needed to make sure that we maintained our park and update them. And that's part of what was expected to be done in 2020 before the pandemic hit. So all those to-dos, some of which have been already accomplished, some of which will continue to be done in 21, will happen, because that's part of the guest experience. And that's for us foremost in what we want to deliver.
And by the same reasoning, are there certain parks that we might have assessed are overinvested that could probably stand less CapEx?
Yes, and I think it goes back to the comment that I made earlier about capital allocation, where we want to deploy marketable capital to parks where there's greater growth potential. So to the extent that perhaps it wasn't being done with the same prism in the past, those by default would have been over-invested relative to what we want to invest in the future. So, but it's more about your perspective on how you're looking at the park as an investment vehicle. And so if you don't see that potential of growth, you just reduce the investments there. But you see more potential in other places, then you put investments in those parks.
One of the most prevalent questions that also I'm anticipating we're going to have through these next few quarters is we will talk with investors and they will say, what should we expect from Six on the quarter? What should we look for? What should we measure them against? And what will, obviously that's up to us to figure out what will cause the stock to react. But what should we reasonably expect from you in the next few quarters, and how would you have us measure you?
Well, I think the key, David, on this is we've been very deliberate in what we've talked about over the course of the last few quarters since Mike started, since February of last year that he started. And there's been a storyline that was developing over the course of the year, notwithstanding the pandemic. So we kind of got back on track with that in October and came back to what we probably would have announced, let's say sometime between May and August, if it hadn't been for the pandemic. And And so measure us against our progress on what we said we were going to do. And so every quarter, and I've done this in the past because I've done in other places, you just want to make sure that you lay out the goalposts and you provide updates on progress towards those goalposts. And it's up to you to judge if we're on track or not on track. And then and we'll be very honest, because we're going to miss on certain things, and we'll tell you we're missing, but what are we doing to get back on track? We know that we're going to go after this value. It may not be a linear path there. We may discover that some things were underestimated and some things were overestimated. We'll update our estimates to reflect our new perspective on what that is. And I think if there's honesty and transparency from our side on where we think things are going longer term, and you follow along with us on the ride, then it'll be easy for you to judge on whether we're credible or not. And that may or may not go into the stock price value. I mean, that's not up to us. It's up to the markets to decide. But what we know is we're committed to the operational value that we want to deliver to our shareholders. And that's exactly what we're going after.
So you may recall when we met for the first time, and this will be my last question. You may recall when we met by phone the first time, I remarked that you come home and say, honey, this is great. I'm going to be CFO of a theme park company during a global pandemic. It's going to be fantastic. My question is, what have you found surprising, so far, either to the positive or the negative versus what you thought it was going to be when you first joined?
Well, I think to the positive, I think the way demand has come screaming back in the face of an incredible avalanche of increasing COVID cases in the United States in particular. That has been a huge, huge indicator to me of latent consumer demand for our brand and for our product. And that has been really, frankly, very much to the positive side. On the not so good side, I would say it's been realization for a while now, because I've been around for a few months. I've been here for 7 months, almost 6 months now. And so, but I was a little surprised at the lack of effective technology deployment. It's not that the company didn't spend money on technology, but I don't know that the dollars that were spent on technology were put in the exact right place. And so you had both the guest experience and the employee experience sub-optimized as a result, and huge amounts of value leakage potentially beginning to happen because of that, which is why we're doing this transformation plan. And let me remind you that on the transformation, we're making certain investments. And I think 2/3 of next year's investments are intended to be technology facing. And so that is really where I think we saw the problem, but we're addressing it. So that to me is really the summary of the good and the not so good.
With about a minute to go, I'll leave it to you in case there are any topics or any closing remarks you'd like to make.
Well, David, thank you very much for doing this with us. It's a privilege. I've actually worked with your firm in the past and many of your colleagues, and I think it's wonderful that you could actually take the time to do this with us. What I'd like to say is, I am super excited about this future of Six Flags. We are an amazing brand, and that's manifested in the consumer demand that actually comes after our brand, even in this environment. We have a balance sheet which is supporting an investment in retooling and enabling a transformation plan that's going to generate significant value to our shareholders. And that's going to deliver an earnings baseline, which we've talked about, of $530 to $560 million in EBITDA. But we're not going to stop there. There's growth beyond. And that is what this is all about, setting that platform for future growth in revenue and earnings.
All right, with that, I'll thank you both for inviting me to do this with you. As I said, it's a critical stock for us. and we enjoyed having the discussion. And thanks for all that tuned in this morning. We appreciate your attention. Have a good day.